Good afternoon, everyone. Welcome to our June 2023 monthly market exchange. We thank you for joining us today. This is Jeff Hibbeler along with Randy Farina. Before we get started, I would like to remind everyone to please send in any questions or comments to info@essentialwealth.com. We will address these questions toward the end of today's call. A lot has transpired since our last call, and possibly the biggest event that we've had in the last month or so has been the debt ceiling legislation passage. As usual, our political leaders took it to the 11th hour to get a deal done and passed. Unfortunately, this is just how the game tends to work. The good news is that its resolution is one less thing for the markets to worry about. And even though it didn't seem to be a big overhang at the time, equities have extended their rally with its resolution and are now near one-year highs. Treasury yields have also moved higher over the last month. Particularly, we've seen this in shorter maturities, but overall, Treasury yields, they remain in this year's trading range. We've also been seeing in markets that, they'll move 1 or 2%, or in fixed income, maybe 10 or 20 basis points in yields following some of the more important economic data releases. And, I think this is a reaction that markets are having as they recalibrate prices to expectations for upcoming Fed policy and the effects the data is having on it. And really, right now the Fed is in a highly data dependent mode, and over time we see that this is kind of a typical situation in market reaction to it. Recently, looking at economic data, it's been, I would characterize it as generally decent. Although when you break it down a little bit, the hard data seems to be a little stronger, and sometimes that's a little more lagging, while the survey and sentiment data seems to be maybe trending a little bit on the weaker side. We saw that a little bit yesterday with the ISM services surveys. But last Friday, we got one of the more major data prints with labor market data. There was some mixed cross currents underneath the headline numbers, but overall it was solid. Headline payrolls were quite strong. The unemployment rate did increase, and there's some survey differences there with different assumptions between the two. But when you mix in unemployment claims and job opening surveys, overall, I would say, the labor market remains quite strong and tight, overall, which is one of the two mandates that the Fed has of maximum employment. So in our first topic, the Fed meeting is next week with their next decision. We've seen a mix of opinions across the Fed in the speeches and papers they've released, both advocating for continuing their hiking and skipping a meeting. The big three I would characterize, Powell, Williams, and Jefferson, have been indicating that it's probably time to take a pause and allow for some time for hikes to filter through. Randy, we've debated, often we debate what the Fed is going to do, what we think they should do, et cetera, and wanted to open it up to you to, what do you think they're going to do here at next week's meeting?
Thanks, Jeff. It was like the economic corner with Jeff Hibbeler. Good introduction, good given lay of the land of some of the economic data that we've had over the past month or so. I think on every call, we say a lot has happened since the last call. That is the markets today. There is always a short-term worry. There is always something that is on the horizon that has people worried, skittish. That is the environment we've been in now for more than a year. I can think back to the June call we did last year. We were probably near the market lows about a year ago, this time June, and then again it bottomed in October. But the June sell-off was pretty significant, and that was on the data print of the CPI back in June. It had accelerated significantly, and then rates took off to reflect that, you know, they were early in their battle with inflation. Now, a lot has transpired in the last year. As you said, there is still a robust economic backdrop, especially on the employment side. Some of the sentiment and survey results have been softer. The one thing I've kind of parsed out through earnings calls that, you know, in companies we own that we've been listening to lately, is that the lower end consumer has definitely felt the squeeze of inflation, and that's starting to show up in actual sales or lack of sales. Dollar General, Target, Dollar Tree have all warned in the last couple of weeks that they're seeing a significant deceleration in the lower end consumer, and in lower end consumers, someone that's making less than 40,000. I think it might be even a household that is less than 40,000. So it definitely, the rate rise, the rate impact, or the Fed's actions over the last year are having an impact. It's lagged. It's always lagged. So as you asked me the question, what do I think the Fed should do? I think they should pause. I think they should let the 10 in the 10 rate hikes, if that's how many it's been, Jeff, I've lost count. The 4% increase in the federal fund rate over the last year plus, they need to let that be absorbed by the economy. We have already seen that it caused significant stress in the banking sector in March. That is probably not over. You did have 3 large banks become insolvent basically over the course of a weekend, given the accounting rules of how you mark to market and how things get classified on their balance sheet, and what gets captured into tier 1 capital ratios, not to go into the details of a bank's accounting. But what the Fed did caused significant stress. So they've erred twice now, Jeff. We've had this call now for 2 years running, and we've talked about policy error. Did they, didn't they? I think it's clear in hindsight they've made 2 policy errors, or potentially 2 policy errors, letting the rates stay at 0 too long post-COVID. And to me, the rapid increase in rates too fast, too soon has caused a little bit of a ripple effect, but time will tell if that was a policy error as well. I know you lean on the side that they should continue to hike, so I'll turn it back to you on what you think they should do this June month, and what do you think they should do over the next couple of meetings?
Yeah, I mean, yeah, you know, to your point that the rapid hikes, you know, they were kind of forced into that to correct their initial policy error. But you know, I think, you know, one thing watching the Fed, you know, over the years, when the big 3, I would, you know, characterize them, the chair, the vice chair, and the head of the New York Fed talk, that those are who you want to listen to the most. And when they're advocating for likely, hey, it's time to take a pause and see the prior effects of our hikes, that's, you know, that they're trying to guide the committee and the markets in that particular direction. Now, you know, of course, as luck would have it, we have CPI next week on the first day of their 2-day meeting. You know, likely that probably doesn't change it unless you get a really big outlier. And, you know, we actually saw that, I don't know, maybe 6 months ago, where we did have a circumstance where the data came in much stronger than expected. And, you know, they were in their communications silent period, and they, you know, did their media communication to kind of steer things. But I think, you know, it probably from because the hikes have been so rapid, because we have seen, you know, some isolated stress in the banking system, you know, from a risk management perspective, it probably makes sense to take a pause and give it a little more time to filter through. I would say, though, they have made it pretty clear that just because they pause or skip this meeting doesn't mean that they're done, and that if things warrant, they may well hike again.
Right.
Um,
And
and,
they've been
and
saying data dependent for a while, and that probably continues. If we were to get, like you mentioned, a spike in CPI, then they would react at the July meeting, I'd assume.
yeah, I would guess so too, if the data continued strong. And I mean, you kind of look at it holistically, as I think they're trying to. You've got a tight labor market. You have inflation that has come down a fair amount from the peak, but it's still kind of staying sticky or well above their 2% target. So I think that one message they've been pretty adamant about is that the odds of them cutting this year are likely pretty low. And the markets are finally starting to get this message, and it's kind of repriced in the last couple weeks that is likely not going to happen. I think it would take a pretty big shock for them to, especially now that we're into June, to do some sort of a cutting toward the end of the year.
And that's a moving target, Jeff. There's plenty of financial press about what's being priced in for rate cuts. In February, there were no rate cuts being priced in. And then you had the economic situation with the banks in March. And that's when 2 to 3 to even 4 rate cuts started to get priced in, because at that moment, the stress in the sector, there was an unknown of, is this 08 again, given, some of the banks that failed in 08 and what that led to. So I think there was an immediate overreaction. As usual, the market overreacts both to the upside and the downside in the moment of stress or the moment of news, because it's trying to calibrate fast and quick, and it overshoots. And so there were a rapid number of rate cuts priced in because the worst case scenario started to be thought of by the market. And then over time, as you said, in the last 4 to 6 weeks, now you're down to, I think, 1 rate cut, if even. So it's step back as portfolio managers, Jeff, as fiduciaries, as running clients' accounts, and in making the investment decisions. We need to think longer term in our seat. The news is always blinking again. Something is a worry, something is a risk. Both, again, it extends on the up and the down. There's an overreaction, and we'll discuss that today maybe on some of the stocks in the S&P. And then there can be an overreaction where the market, has an October event like last year or even the summer. And what we need to do is just think longer term about who wins, who loses from however the situation plays out. I have no Fed vote. I know you'd like me to have one, Jeff, but I don't have one. So what happens next week is outside of my control. What the Fed does is outside of all of our control. What we try to do is anticipate, and that doesn't mean we always get it right, but we try not to overreact to the near term and try to make decisions that we think, as we look through an investment cycle or a business cycle or an economic cycle, who are the winners, who are the losers, and that's how we try to position the portfolios. There can be times where we're lagging our benchmark or our bogey or however you're measuring us. But what you have to keep in the back of the mind is that over the longer term, through an investment cycle, is how you want to judge a manager or an individual strategy. So just wanted to make sure, as we're always talking about something that's short term, Jeff, we also want the perspective of the longer term as an investment managers.
Yeah, that's a good point. And I think, also just trying to back away, not only, like you said earlier, some economic highlights, but it does seem with the cycle that, we've had very high savings coming into it. We may have seen some changes in the post-COVID environment that seem like maybe it's pushing the cycle out. But I think trying to take that long stance that, we've been maintaining kind of a balanced, but I would say cautious approach in strategies. We've I think been generally maintaining that for the last few quarters, because this cycle has been somewhat maybe unusual and different from other ones. and it's playing out a little bit differently than, all cycles are, of course, different, but this one's been unique, and it plays out a little bit. So it's the patience and the long view is, your point's well taken and said on that.
Yeah, things rhyme, but cycles rhyme, but the underlying drivers and impacts can be different each cycle. So you're right, this cycle is definitely different than the other cycles you and I have been a part of, for sure.
Well, speaking of cycles, want to transition into our second topic with looking at international equities. And before we jump into that, I was looking at the calendar today, and today is D-Day. And I'd be remiss not to mention that the 79th anniversary of the Normandy invasion, and clearly the heroic efforts of the men and women that day that helped to begin turning the tide in World War II. But so looking internationally at the international strategies and equities, wanted to dig into it because we have seen a lot of movement in the cycle over not only the last decade, but decades. And I guess starting out, Randy, we're looking at the just kind of allocation and diversifiers, but from the investment perspective, just to kind of frame it, because we tend to be U.S. focused, a lot of investors are. How large is the international opportunity across markets?
Sure, and I'll also be remiss if I didn't mention D-Day as well. There was a cool video yesterday. I think one of the airlines, Delta or someone in the U.S., flew the remaining those that are alive to go over to Normandy to celebrate the 79th anniversary. It was pretty cool. If you get a chance to look at that video, I saw it on YouTube or something yesterday. It was definitely it was moving to actually see. They're all in wheelchairs, they're all in their 90s. It was stunning in the movement of it. So I'm not sure that's the lead way into international investing, but we'll take it. So yeah, there's something called the home country bias. I've been following international markets for almost 25 years now. I've always run a U.S. and an international fund as a portfolio manager. So I have no axe to grind in terms of how money gets allocated. At certain points in time, international is more attractive than U.S. and vice versa. There's something, again, called the home country bias. Every citizen of their home country overweights their own country. So if you're in Japan, you're overweight Japanese equities. If you're in Europe, Germany, you're overweight in German equities. If you're in the US, you're overweight in US equities. Sometimes that can be the right move. Now, if you were to actually look at the world, how it breaks down by market cap or opportunity, US, so all publicly traded US companies aggregate up to about 60% of the opportunity set. So 60% of the world's publicly traded markets is US. You have about 10% in emerging markets and about 30% in developed markets. So developed markets would be Europe, Japan, Australia, New Zealand, South Korea, where emerging markets are your China, Taiwan, Hong Kong. It's considered an emerging market for some. It probably shouldn't be, but it is. Russia, Brazil, some of the smaller South American countries. And then there's even frontier markets, which would be Saudi Arabia, Pakistan. So that's how the world breaks down. 60% US, 40% non-US, with about a third of that being developed markets and 10% being emerging markets. So you should be diversified always across, size, small caps, large caps, and global equity. So that's the allocation, Jeff. Again, it's about a third of global markets, and I'd say the average U.S. investor has about 10% in international. So we've been, as a country or as an investment base of citizens, underweight international, but it hasn't hurt because the U.S. has dominated over the last decade, especially the S&P. The S&P has beaten the S&P 500, and the U.S. representative index large cap index has beaten every available investment opportunity in equity. It's beaten emerging markets, international, small cap. It's been the right allocation to be underweight international, but that's not necessarily the case going forward. You always want to be diversified because it's hard to know what the drivers of outperformance or of long-term performance will be for any one area of the market. So it's better to have broad exposure to those markets.
Mm-hmm. And, you're talking about this latest cycle. We were talking a little bit about it on the team call a bit ago, but the S&P's outperformance has been pretty dramatic over the last 10, 12 years. And there's particular drivers of that, but do you want to go in a little more details
Sure.
on that?
Yep. So as you mentioned, and I mentioned, the S&P has significantly outperformed the last decade. There is certainly a driver behind that. One, global growth has been driven more by the US than Europe. So US GDP growth on average, say 3% the last decade, where Europe struggled coming out of the GFC, and there were a bunch of crises called the PIGS crisis, where there were sovereign debt issues in Italy, Germany, Portugal, and Greece. I got it backwards, but PIGS was the representative of all those countries. That happened more than once. I think it was 2011 and 2014 or 15, Jeff, where there was the PIGS 2 crisis happened. So there was some, concern that the sovereign debt of the countries was going to potentially cause significant ripple effects throughout the continent. So there was very slow, anemic growth in the European markets over the last decade. Japan has been in a deflationary, up until the last couple of months, a decades-long deflationary environment. Since the late 80s, Japan peaked, and in fact, the market just touched a 33-year high. So that's how long it's taken Japan to come back from its dominance or its over investment in the 70s and 80s. But again, over the last decade, Japan has been characterized with slow growth and deflation. So again, the US was the winner. China definitely grew faster, but a lot of that was in investment in infrastructure. And we've all heard or seen stories about, there's these ghost towns in in China, no ghost towns in Florida, believe me, ghost towns in China where they overinvested significantly. And, they have these large, complexes of dozens of apartment buildings that are empty. So there's probably been a misallocation of capital in Japan, but that did help global growth, and China did grow faster than the US. But again, given some of the structural inefficiencies and some of the issues with capital controls and whatnot in China, it's not been the best area to invest in. So US dominated because global growth was good, and you had some interesting developments in technology. Apple, definitely won the handset war, and that drove the valuation of that company. Same thing with Google as, the search engine, and YouTube. Meta, didn't IPO until 2012, and that's been a phenomenal investment, even with its volatility in the last couple of years. So you've had these emergent of these significant dominant players. Even Microsoft reinvented itself. Microsoft, we were just talking about this morning, peaked in 2000, and it took 17 years before the price of Microsoft eclipsed its peak in 2000. It wasn't until 2017 that Microsoft was worth more than it was in 2000. And that's because the cloud became a new growth engine for them. So what has happened over the last decade is there's been a handful of companies, we know their names, the FANG or the Magnificent Seven or whatever you want to call them. They've really driven the returns in the S&P. And for a reason, their cash flow growth was huge. The market rewards cash flow growth over the long term. So it rewarded the US companies that were able to produce cash flow. But now Now my fear, or not fear, let me rephrase that. My concern is that the S&P 500 is dominated by 10 companies. 31 or 30+% of the S&P now is made up of the top 10 companies. That is the most ever in terms of concentration in the top 10. So what you want to have, and what we advise and what we run portfolios based on, is some level of diversification. You don't want all your eggs in one basket. Now, these happen to be the 10 best or biggest stocks. That doesn't necessarily mean they'll be the next best investments for the next decade. So there is a situation today that's developed. Concentration in a few names have driven the S&P's top 10 weighting to a record high. And I'm a little bit concerned that the valuation on those 10 names are not as attractive as they were 3 to 4 to 5 years ago. And that there's a whole area of the market that is probably has a chance of doing better over the next decade, given its valuation. I'll stop there to let you ask any questions, but that's my concern, that the S&P, again, dominated by 10 companies, may be masking the underlying, again, year to date, those companies are up 30 to 40% on average, where the average S&P company is negative. So the S&P being up 12% year to date has really been driven by those 10 companies.
Well, Randy, you just mentioned valuation, and that's an important part of our investment process. So I know you kind of talked about the concentration, but overall, kind of more broadly, how do the markets line up, international versus U.S. from a valuation perspective?
Right. Good question. And valuation is the anchor, the linchpin of our process. I think the more you pay for an asset at the start of your investment, the higher the multiple you pay on whether it's earnings, EBITDA, cash flow. Likelihood the returns, the lower the returns. We're not deep value investors. We use what we feel is an intrinsic value approach, trying to capture companies' moats, companies' growth rates, companies' margins, companies' strategic and operational and financial strategies or focus, is trying to incorporate it into how we value a business. But today's, I started investing in the bubble.com. I was an analyst in June of '99. The market doubled almost in the fourth quarter of the NASDAQ in 1999. And a lot of those companies that were prominent back then, no one's ever heard of, probably, that just didn't entered this business in the last decade. There were companies like Nortel, Lucid, Nokia, everyone's heard of, but those were massive companies, 100, 200, 300 billion plus companies that are now either bankrupt, acquired, or a shell of themselves. Nokia is a $20 billion company now that peaked at 500 billion. So what happens is that, sometimes valuation, gets ignored during a theme. And remember, in 2020, disruption was the theme. Cathie Wood's ARK Fund was a theme. And a lot of those assets got, stocks doubled and tripled, but then the reality of the potential growth of the segment or company's business wasn't accurately being reflected in the stock price. It was, you were pricing a crazy scenario, or let me rephrase that. You were pricing a unlikely scenario that would need to develop for the next decade for them to justify the valuation they were trading at. So always be, valuation is the first and foremost thing we focus on. Today's valuation of the S&P is about 20 times at FY1. But if you remove the top 10, which you shouldn't, but if you do, it's about 15 times. So underlying, there's some opportunity for cheapness in the stocks there. In the international markets, which we use a benchmark called the EAFE, EAFE, the MSCI EAFE, that represents the international markets like the S&P does in the US. That's trading about 13 times. So there is definitely a opportunity set of cheaper international companies than there are US at the moment. And again, that's why you want to have exposure to the asset class, asset classes broadly, not just all your eggs in the S&P 500. So again, to answer your question, Jeff, in long-winded nature, S&P today is at 19 times, international markets at 13. And again, that S&P is being dominated by the top 10 companies, which trade at a much higher multiple. And one of the stocks, NVIDIA, everyone has seen the news lately, and that stock's gone up dramatically. That we don't own it in the portfolio. I've owned it personally in the past. It's a great company, but today it's trading at 50 times EBITDA. The last, I again had the benefit of investing through a bubble a few times. And I know in the tech bubble, a lot of names that got over 50 times EBITDA, it took a decade for a lot of those companies to recover and to give a positive return on the investment. I think buying something at 50 times EBITDA is not a recipe for a decent long-term return. And I'd be a little bit leery of some of the names that have driven the S&P up year to date. I think Apple's even one that is expensive, fairly valued-ish, certainly not in the class of an NVIDIA, but a lot of the larger names are, I think, pricing in a revenue and free cash flow stream into the future that is maybe not as attractive as it was a couple of years ago or even 6 months ago. So again, that's how I'm looking at valuation, and I think international is an opportunity set right now.
Yeah, thanks for talking about NVIDIA and some of those. That was actually a client question that we had received regarding their big run. So that was some good perspective on kind of where they're at. With international and in the U.S., you alluded to this some, but want to just talk a little bit more. There are compositional differences between the U.S. and international markets. Sometimes it's characterized a little bit growth and value-y, but it's also, some of that is just due to the sectors.
Right.
And so wanted to dig into a little bit of those differences and, how that kind of also helps to diversify an asset allocation.
Yeah, and that has really what's been the outperformance over the last decade of the S&P versus international. S&P is dominated by tech companies. We all know the names, Apple, Microsoft, Amazon, Google, Meta, NVIDIA. There's not a lot of counterparts in the international market. So the technology and consumer weighting and comm services is now what they call Meta and Netflix and those names. That is about 50% of the S&P. And if you were to look at the international markets, it's only around 20 to 25%. So the US is overweighted, or not overweighted. The US has just a much larger exposure in those sectors. Again, technology, consumer services, and some parts of consumer discretionary. Apple's in the consumer discretionary. No, Apple's in tech, sorry. So that has been some of the reason. But those were, again, much cheaper a decade ago. Apple traded at 13 times for a number of years. Microsoft traded at 15 times and below for a number of years. The success they've had has now driven up the valuation in those names to a situation where, they're just not as attractive as they were. And in some of the other sectors, consumer staples, healthcare, consumer discretionary, even financials, although, we don't own many banks, if any, would look at more service related, insurance related companies within financials, I think can offer a more attractive risk reward scenario over the next, 5-year or investment cycle per se. So it's not that I don't like those companies. We own some of them in our portfolios. We're underweight the benchmark and a few of the names, and I own them personally. Apple's my biggest holding personally. But that doesn't necessarily mean it's going to be the best investment going forward. What we're trying to accomplish is try to find the best risk reward opportunity, stock by stock, that builds up into a portfolio to give you the chance of creating wealth. And the starting valuation, whether you again use price to earnings, price to book, or some metric of trying to look at a company's starting valuation, the higher the starting point, typically the lower the return over time. And that's where I think potentially the S&P is at today. I just think you should have a more, if you can diversify into some areas of value, some areas of small cap, some areas of international, I think it makes sense. That's kind of my bottom line, just from experienced grizzled veteran portfolio manager. I just think the opportunities are not just in the top 10 stocks within the S&P today.
Yeah, I agree. Really quick on that same line, maybe one last thing that I wanted to talk about is, part of what factors into the top 10 holdings growing is kind of the whole passive versus active dynamic. And in the US, there's a lot of passive fund activity. How does that contrast with international? Is there more or less over there? Does that help with active management in the international markets?
Good question. And the way I look at active passive is, you can go by the benchmark, right? You can buy the IVV, which is the S&P 500 benchmark, or you can buy the EFA, which is the EFA benchmark. Now, when you look at those benchmarks through time versus the set of active managers, where do they rank? The S&P benchmark ranks in the top quartile to top decile over the last 3, 5, and 10 years, meaning it's been very hard for active managers to beat that benchmark. And it's really because of a lot of the concentration, a lot of the 10 stocks that have driven it. If you've been underweight or haven't owned one of those, you've had a tough time keeping pace. So whether the flows from the passive 401k and all that impact that, I'm not so sure. I kind of look at it as, is there an opportunity for an active manager to add value? And in that particular asset class over the last 10 years, no. But I think over the next decade, and again, every active manager says this, of course, but I honestly believe it, there is going to be an opportunity, because I do think there's an issue with concentration. And again, as you go back through time, it's not sustained. 10 companies haven't sustained, the same 10 companies haven't sustained their lead forever. So again, Nortel was a top 5, GE was a top 5, Lucent was a top 10. These companies are gone. Now, one of these, 2 of these, 3 of these top 10 companies today will lose their edge, will stumble, will have a competitor come in and gut their moat. It's just, it happens. Don't know which ones right now, and it'll become more evident as time goes on. Like, you could have got out of Nokia plenty of times. It didn't just go from 500 billion to 20 billion overnight. It took a decade, but you could see them losing their edge. You could see a new entrant in Apple. You could see Samsung coming along. You could just see their stranglehold they had on the smartphone market or cell phone market at that point eroding. So there are signals that help you get out of that. But back to the active passive debate on the international side, the ability for an active manager, the benchmark only sits in about the 40th percentile, meaning the odds of beating the benchmark are much higher in the international markets against the versus the S&P managers. And I think a lot of it is because it's just not as concentrated. So you have an opportunity for stock selection to be much more of an impact, and some of your tactical allocations to sector through an investment cycle can have more of an impact. You just haven't had to own 10 names for it to be meaningful in terms of outperformance like it is in the S&P. So I do think, again, and small caps are definitely a flat bench where active management can have an impact, and I think international markets as well. And again, the S&P hasn't had that for the last decade, but I do think, given its current state, I do think it is a place that can have some active ability over the next decade.
Very good. And I guess maybe just to kind of wrap it up, like, we have been advocating for well over a year now is the importance of maintaining a balanced, risk managed asset allocation. It varies, of course, across clients. Everyone has unique risk and rewards, and certainly we that's we rely on our advisor team. They're the quarterback of the relationship of determining that. But just kind of in general, with where the markets are at, we do recommend that balanced approach overall to asset allocations.
Yeah, and if I could just add to that, our CIO Tim Courtney I think, and he doesn't set my bonus, so I'm not kissing up to the CIO at all. Who sets my bonus? I don't even know. Maybe I can kiss up to
the
that
committee, Randy.
Oh, it's a committee. Oh God, forget it. Then I have no hope. No, Tim has done a good job over the last year or so saying, hey, this asset, if you need to raise assets or money in your accounts, I remember him late last fall saying, don't sell your growth assets now. They've declined. They've been hammered. S&P's down 18%. Large growth was down 30%. Sell your value stocks or strategies that you own if you need to raise cash. Again, if you need to raise cash, again, shouldn't really be in equities if you need that cash in the next 5 years. I never thought that, you should be you need to have your rainy day and your living expenses and all that separate from your equity investments. You're investing in equities for the long run, for 10 and 20 and 30 years. So he was saying, the area you should be selling again in the fall was value and buying growth potentially, or not at selling the growth. I think that's flipped on its head now. I think now is the time where maybe you lighten up on the growth. You should be buying a little bit more value, lighten up on the S&P, buy a little bit more small cap, buy a little bit more international. And again, this isn't to get the trade right for the next quarter or the next 6 months. I have no idea what the market's going to do in the short term or how the different asset classes will play out. But you want to have a balanced approach when things have run up. You want to use that as an opportunity to maybe lower that weighting and allocate to the things that haven't done as well. And I think over time, that can be your, asset allocation tactical, from the big picture and how to make sure your portfolio is properly diversified. So again, that we've done a good job, I think, communicating as a firm when some of the areas we think are an area where you should be lessening and also allocating to the areas that might have been an opportunity. And I think that's what we're trying to do today.
Absolutely. All right. Well, at this point, there are no further questions. So we'll go ahead and conclude today's discussion. Please join us next month. We're going to actually have our semi-annual webinar, and it's going to be on Tuesday, July 25th at 12 o'clock p.m. Eastern. More information on that to follow at a later date. So we do thank everyone, though, for joining us today, and we hope you have a great rest of your week.
Thank you.